Hey everybody, it's Michael Martin. Thanks for being here. So I wanted to do some follow-up on the video I did on position sizing. Um, the title was What Most Traders Get Wrong About Position Sizing, which, again, we're splitting hairs here, right? So it's not definitively wrong or they're definitively right because the thing ebbs and flows and you're really making these adjustments in real time. So say you're working at a place where they have these tiers. To me, that's more of a managerial decision, right, than it is looking at things based on the dynamic, volatility of the marketplace. And I can see why it's done, and I think it's prudent, right? So I'm not poo-pooing it. But what it does do, if you're in that process, is it conditions you to think in one particular way. What do I mean by that? Well, at any given time, your line of credit, your account balance, whatever it is reacting to the positions that you have in the marketplace. And in my opinion, we really make and lose our money by position sizing, not by, that's why I go crazy when I hear these companies talking about technical packages and technical analysis and sniper your entries. It's not really that important, to sniper your entry. Yeah, again, if you're trading 30,000 shares of a 6-cent stock, a penny can be, painful. But I'm talking about trying to make real money, right, with positions over a longer period of time. You have to be able to sleep at night, but also have enough risk on so that it makes sense for you when the thing does move in your favor. So think about having a hedgerow. Like it can be a beautiful 8-foot hedgerow, but it still needs to be pruned, right? So when you find yourself in a position, and again, I'm not talking about intraday stuff. I'm talking about taking risk home overnight over the weekends, right? You have to conjugate that position size, right, with the volatility of the instrument and also with respect to where your account balance is. If you're up, 200% already year to date, regardless of your account size, emotionally you can freewheel a little bit, not to just gamble, but you have it to give, right? Whereas if you're in a 20% drawdown and you're trading 80-cent dollars, it's a different mindset on how you handle the risk, right? So my take on all of this is that focus on your position sizing and dynamically adjust that, because if you're trading, say, tens, for example, 10 contracts or 1,000 shares of, 10 future contracts, maybe, 5 option contracts, and maybe share sizes, you're looking at 1,000 shares, you might find that you can optimize your behavior better if you looked at, say, 1,050 shares, right? Or 900 shares for your style of trading. So that you can do that by testing. You can also do that by looking at the results that you have. So where I do think entries and exits are important, they have to be conjugated to the position size, because, you can't just say having a $1 stop, for example, or a 10-point stop on the E-mini or blah, blah, blah is optimal until you've actually done it in real time. And then you might find that you don't have enough risk on, which is actually a big problem. In my experience, I think the professional traders do a really good job of knowing not to have too much risk on. But the one thing that I found is that oftentimes they don't have enough on. And this is in the face of me totally agreeing with the idea that the job for us as speculators, as traders, is to play superior defense. That's job number one. And so, yeah, that seems weird to hear when you're thinking about, well, our job is to make money. Yes, but at what cost? Because ultimately, if you see somebody and they're in these trading contests and this and that, which I don't necessarily think they mean anything, it can bring out the worst of you. Because the key is risk-adjusted returns. If you're going to make 150% but have to live through a 60% drawdown, is that the type of trade-off that you want, right? Whereas if you make an 80% and you only have an 8% drawdown, that to me would be remarkable. You see what I'm getting at? So I think you have to look at risk-adjusted returns. What is the return that you're getting for the risk that you're taking? Because you always have to be concerned about the drawdown, which I think you have to insure against first. And that becomes a function of your entry and your exit and your position sizing. So don't sell yourself short by trading too small, and don't throw caution to the wind by trading too big. I think the position sizing thing is much more dynamic. And even if you're going to trade, say, gold futures or NVIDIA stock, even if you're risking, say, 1/4%, you might find that your position sizing is different from day to day to day, right? So look at it and make sure that it's at least something that you think about from time to time. I'm going to do a longer form video on adjusting position sizes and how do you know when and how to scale, because it's very hard to do in an audio only, format. And it's going to take some, whiteboard action. The only problem that I have right now is that I don't like the whiteboard action scenario that I have here. I have to use a tablet and a stylus, and the quality of the video for your viewing doesn't come out as good as if I'm using like the 4K camera that I have here. So I'm going to work on that and figure out what's best so that I can go through some examples so you can kind of see. Because I think one of the things that guys do, especially if they're newer, they're younger, and they have smaller account sizes, they want to go from trading ones and twos to 20s. And it's just not practical. You don't make that type of a leap. It's much more dynamic based on the volatility of the instrument that you're trading as well as the size of your account. So the growth is much more gradual. You go from ones to twos to threes to threes to fours, like this and that. It's not practical to jump by that type of a factor of, say, 5 or more, unless you're going to get a bigger allocation, or the place where you're working gives you a larger allocation or line of credit, so to speak. So you want to stay kind of consistent in your behavior. Part of that behavior is choosing the most dynamic position sizes for the risk that you're willing to take. Again, we talked about patience yesterday. It's going to take you a while to get where you want to be. Again, what's the goal? Do you want to walk around town and say to everybody that you're trading 20s? Because to be frank, no one's going to care. It doesn't mean anything. So you want to think about focusing on what matters most, and that is, can you behave consistently? Behavior predicts where you end up, right? So focus on what really matters more than stuff that might satisfy your ego. There's nothing to feel insecure about. Everybody starts with 0. Richard Dennis, right, of C&D Commodities, who trained all those turtle guys, he started with a couple $100. Everyone's got to start somewhere. So just enjoy the process and focus on the process, as opposed to, I want to be Paul Tudor Jones in a year. It doesn't work that way, So it goes back to being patient. And I think growing your money has a lot to do with, yes, your entries and exits do matter, but they have to be conjugated with the position size, because that's where we make and lose money. As always, I appreciate your feedback and your comments. Please like and subscribe, and send your comments along. I don't have all the answers. I can only speak to what it is that I've gone through, and then share my experience, strength, and hope, that it might help you in your endeavors and in your journey as you grow in this business. All right, so thanks for being here, folks. I will see you next week.